Welcome to AM Best Audio.
Hello and welcome. Thank you for joining this AM Best briefing, where we will cover our outlooks for the main segments of the U.S. insurance industry. I'm Stefan Holzberger, Chief Operating Officer at AM Best, and I will be your moderator today. I'm going to move into the agenda, where I will go over the topics we have for you today and introduce my fellow panelists. So I will kick things off today with an overview of the U.S. economic indicators, giving you a macro perspective. And from there, Rich Attanasio will cover the market segment outlook for personal lines. Alan Murray will cover commercial lines. We'll then move over to Carlos Wong-Fupei, who's going to broaden the scope a little bit and talk about global reinsurance, the reinsurance segment being more globally syndicated than the others, particularly with regard to property reinsurance. From there, Mike Porcelli is going to cover life and annuity. Sally Rosen will take us through the health outlook. And last but certainly not least, Don Walker will take us through the Delegated Underwriting Authority Enterprises outlook, and DUAE for short. And that's really covering various players in the DUAE market, MGAs, MGUs, cover holders, program administrators, and the like. So as I mentioned, we're going to start off with a high-level look at the macroeconomic indicators that will give us a perspective of the arena that all insurance organizations have to compete in the United States. So starting off with GDP, U.S. growth and productivity continues to compare favorably to other mature market economies. The IMF projects GDP at 2.8% for full year 2024, and that's after growing 2.9% in 2023. So relatively robust growth, particularly with regard to other mature market economies. That said, GDP is expected to moderate in 2025 at around 2%, with a good deal of uncertainty surrounding new government policies on trade and immigration, and as well as the lagged impact of tighter monetary policy, the implications we're seeing in the market today. Moving over to inflation. Headline inflation, as you can see from this chart, has come down from a peak of 8.9% in June of 2022 to its current rate of 2.6% in October of 24. Core inflation, which excludes the volatile food and energy prices, peaked at 6.6% in September of 2022 and has fallen to 3.3% in October of 24. Inflation has trended down, but still hasn't reached the Fed target of 2%. Core inflation continues to be sticky, especially with regard to services and housing. And expansionary fiscal policies such as tax cuts and government spending could add to inflationary pressures in 2025. Taking a look at the labor market, the unemployment rate is expected to rise modestly but remain below historical averages. So talk of a weak labor market we feel is somewhat overblown. You can see the non-farm payrolls in the blue bars and the unemployment rate in red on this chart. And it's not in the data presented here, but the recently published November statistics showed a strong addition of 227,000 jobs. So although there is a moderating effect, we do not consider the labor market to be weak as it currently stands. And finally, moving over to interest rates, you see the Fed has cut rates twice since September for a total of 75 basis points, with a federal funds rate in the range of 4.5% to 4.75%. The Federal Open Market Committee meeting is on December 18th, where an additional 25 basis point rate cut is expected. 10-year Treasury started the year at 3.6%, rose sharply mid-year to 4.7%, and is currently hovering around 4.2%. So volatility reflects broad uncertainty in both the domestic and global markets, and we do expect that volatility to continue in 2025. So in summary, U.S. economy remains strong, particularly compared to other mature market economies, but as is the case within the broader insurance industry, uncertainty abounds going into 2025. All right, so with that backdrop, let's get into the insurance market segment outlooks, and we're going to start with personal lines, and with that, Rich, I'll hand over to you.
Yeah, thanks, Stefan. So we have changed the outlook on personal lines to stable from negative. It had originally gone to negative in the summer of 22, given some of the loss cost pressures and rate adequacy issues that we had seen. This change goes along with a change in the personal auto subsegment that went from negative to stable. And these two are very closely connected because personal auto accounts for more than 50% of the premium in the personal line space. Now, the change in the outlook reflects improved rate segmentation and more granular pricing segmentation and just a generally improved rate environment that we have seen. So as a result, we are seeing material improvement in terms of personal auto underwriting performance. And this performance improvement is really partially driven by a more accommodating regulatory environment, particularly with regards to rate increases and rate adequacy. Given the macroeconomic conditions post-COVID, regulators had recognized the need for really large rate increases due to the challenging market conditions. These post-pandemic rate needs reflected inflationary pressures on parts, labor, as well as medical costs. In addition, there has been an increase unfortunately, in fatalities and severe injuries in motor vehicle accidents, as well as litigation loss increasing. So pricing segmentation continues to evolve and really is a key factor when you're looking at the personal auto space. Carriers continue to develop more refined granularity regarding their risk factors and overall level of exposure. And this not only gets you to a better rate for the risk, but it also allows you to more clearly hone your risk appetite and cull books of business that fall outside of your tolerance levels to bring a little bit more underwriting refinement to the segment. Now, companies are continuing to leverage technology to support these underwriting initiatives and the rate revision process. Personal auto, as I think many know, has long benefited from leveraging technology, particularly in the underwriting process. And we're seeing that continue to evolve with greater adoption, across the industry, because the investment in the data and the tools, continues to become more and more cost effective. Another tailwind, and again, the personal lines tends to be relatively short term, so it's not much of a tail, but it is favorable in terms of an improved interest rate environment, and that obviously higher bond yields leads to greater investment income, which is a nice offset to if there are underwriting losses. But really, when we're seeing favorable underwriting on auto, it's another kicker in terms of the results that are being reported. Risk management, always a key thing we look at. How do they manage ongoing volatility, particularly from a weather perspective? And again, companies are refining their risk appetites. They are taking steps to really understand their book of business and to price it appropriately. In some cases, those without scale or a unique competitive advantage or a niche have exited markets altogether. It's just a function of not being able to produce the results that are required. It's most prevalent on the homeowner side, although we have seen some companies that have a small auto book exit that line as well. So despite the fact there's been a lot of rate increases and pretty aggressive exposure management, results really continue to demonstrate volatility, which brings us to the offsetting factors in terms of the stable. So, like I said, challenges remain, right? And the biggest challenge is the volatility in weather, in results, and that's mostly on the homeowners line. So the homeowners sub-segment line maintains a negative outlook at this point. Here again, obviously an active hurricane season companies having to deal with hurricanes as well as secondary perils in terms of severe consecutive storms or wildfires. The increased impact of these events makes catastrophe risk management and enterprise risk management extremely important in terms of managing the book of business. So although rate adequacy, particularly on the auto line, has improved, overall loss costs, they do remain elevated, right? I mean, the rate of inflation has declined, but there is still inflationary pressure that has to be considered. With regards to homeowners, carriers have been pushing rate pretty aggressively, but it's just more challenging, inherently more challenging to manage that book of business, particularly since you have typical 12-month policies versus 6-month on the auto, so there's a longer lead time in terms of earning those rate adjustments. And there was a bigger gap to fill up. The other issue with regards to property is there's a lot of variables, right? It's not like you could segment group cars, and driver behavior, and you can do that, systematically. It's a little bit harder with regards to property. We are seeing that transpire with bi-peril pricing, seeing some pretty positive things there, but it is more challenging to get rate adequacy right now on personal property as opposed to auto. So what's been happening as these companies have tried to manage this, you have the overlay of the current reinsurance programs, right? So companies have their retentions driven up and their co-participations driven up, leading to more net losses for companies to absorb. And that's really been sort of the issue for a lot of companies, particularly ones that are small or very concentrating. Having those multiple events and being able to manage through them consistently has been a challenge, and that seems to be the case currently. Now, in comparison to prior 2 years, reinsurance terms and conditions and pricing, it's certainly not as chaotic as it was. There's been rumblings that potentially there'll be some softening there, but if it were to be, we don't think it would be very material. Again, because companies are having to retain more, either retention-wise or co-participation-wise, and those two things just make higher losses for them to face. Here again, we do, and by the way, I mean, aggregate reinsurance to be able to absorb those multiple events, that's just has not been available. There's some indications that perhaps it might be going forward, but we'll have to see what the details are in terms of the level of protection and obviously the cost that would be associated with it. So here again, we see companies reevaluating the risk appetites and to deal with this new normal in terms of frequency and severity. And that's something that we think we're going to continue. So just to conclude, the stable outlook indicates our expectation that market trends will have a neutral impact on companies operating in the space. It doesn't mean that all companies in that space have a stable outlook. It's really a function of how the company is managing their current challenges. So carriers that have not been able to do that or have been slow to address these market conditions, or they don't have the means or the expertise or the technological capabilities to keep pace, they may face rating pressure. Conversely, those that have been able to stay ahead of trend to a meaningful degree, they are certainly more favorably positioned on a prospective basis.
All right, very good. Thank you, Rich. So we're going to take a couple questions before we move over to the next segment, and I would encourage you, attendees today, to use the Q&A tab and submit your questions. We'll take as many as time allows. So sticking with personal lines, Rich, given market conditions, have we seen an increase in carrier consolidation?
Yeah, I mean, there's certainly been an uptick in terms of consolidation, and part of that is related to the evaluation, risk profile evaluation, risk appetite that companies are doing. So either deciding to exit altogether because they don't have the scale or they don't have the market depth. That's what we're seeing. This is particularly true for smaller companies where they've had multiple years of losses and their improvement actions haven't really had a chance to materialize, or they haven't shown up as materializing. I would say the other thing is that there's a fair number of mutual companies in this space, some on the smaller side, that have gone the affiliation route, right, to help alleviate some of the issues that they're facing. Sometimes it's as part of a succession plan where they don't necessarily have somebody in place to resume the role of in senior management, or they just need to find some sort of an exit strategy while still protecting their mutual policy holders. So it's usually a smaller company, not always in distress, but sometimes in distress, that link with sometimes a bigger company that has greater scale, greater access to systems and management. So we are seeing more of that, and I think we're probably going to continue to see that as long as there's these issues on the homeowner line of business anyway.
All right, very good. Let's go one more before we move on. This is one that's picked up a lot of headlines through the course of this year. What accounts for the more accommodating regulatory response now versus during earlier periods, say post-COVID?
Yeah, I would say post-COVID, I think everyone was caught off guard in terms of the degree of inflation that we saw over a relatively short period of time. That those loss costs accelerated rather quickly. Prior to COVID, companies would be pretty diligent in their implementation of rate increases on a pretty steady scale. Able to identify trends and respond to those trends, and take relatively small increases just to manage that. The increase in loss costs was very severe, right? And as a result of that, there was a bit of a backlog, really, in terms of the number of filings that regulators were seeing. And the regulator, they have to consider affordability and availability, right? They have to manage that. At the same time that they're getting big increases, a lot of them, there's staffing issues, right? A lot of, during COVID, a lot of people said, maybe it's time for me to retire. And as a result of that, there were some staffing issues in some jurisdictions, not all. So, you think you put all these things together, that you can see the reason as to why the rate increases got to be so high. I think what's different now is that pace of growth has slowed. Companies are able to sort of get back to, they've gotten to a rate adequacy position over several years. The rate of growth has slowed in terms of loss costs. It's still going up, but has slowed. And all that gives them an opportunity to really catch up, and I think get back to that more moderate cycle of smaller rates more frequently. Companies fell behind trend as part of the issue that we saw from a regulatory perspective.
All right, very good. We're getting some good questions in from the audience, so we'll skip around here just ever so slightly. A question from Mike Porcelli. Regarding affiliations, do they happen with life companies as well as P&C companies? Can you respond to that one, Mike, before we move on?
Well, the answer is yes. There's a lot of different ways to look at the company being affiliated, and I think one of the trends that we're seeing a lot more of now is the sidecar. And it seems like every company that I talk to that's thinking about doing a sidecar suddenly decides to do one. And we're even seeing companies that are now on their third sidecar. So there is still affiliation relationships there. One of the things that you'll see is potential tail risk that can come back to the original company that wrote the business. In addition, there's also investment management agreements that are sometimes put in place too, and the ability to decide what kind of investments are used within the sidecar. But affiliations are definitely something that we're looking at more and more. The other question that comes to mind is when someone originates an asset, is that still, does the affiliation tag still go along with it? And that's something that we have to examine in the rating process.
All right, very good. So let's move over now to commercial lines. Alan, can you take us through that segment outlook?
Sure. We have the prompter. AM Best is maintaining its outlook for the U.S. commercial lines at stable, and this is supported by a number of key factors. First, we've seen persistently strong underwriting performance for the U.S. P&C commercial lines through 2023 and 3/4 of 2024, despite substantial economic and capital market volatility. Now, this is contrasted with the strain seen in the personal lines marketplace over the past 2 to 3 years, as Rich alluded to, but it has resulted in outperformance by commercial and specialty lines insurers broadly within the sector. We've also seen sustained risk-adjusted pricing strength for most classes of business and moderating inflation, both economic inflation, as was referred to in the economic conversation earlier, but also social inflation, particularly affecting property lines and helping to stabilize reinsurance costs and capacity for ceding insurers. There's also been continuity in the improved investment returns, also as outlined in the opening economic commentary, especially in fixed income portfolios, which have bolstered operating profitability, especially in the reserve and asset-intensive longer-tailed casualty lines, which make up a very substantial portion of the U.S. commercial lines P&C marketplace. Another consideration is that commercial insurers' reserve adequacy has been sustained overall, an important consideration for both capital strength and earnings quality, as well as pricing adequacy, although with notable variability by line of business. In particular, although workers' compensation continues to deliver favorable, if diminishing, reserve releases year by year, these have been meaningfully offset by a trend in general liability and casualty lines, which have seen adverse claim trends, especially for accident years 2016 through 2019, in large part reflecting social inflation trends. Finally, despite some notable softness in pricing in the directors and officers lines and other management liability lines of business, as well as in the cyberspace, we've seen fairly broad-based discipline in the sector regarding risk selection, terms and conditions, and capacity deployment, as evidenced in part by the continuation of strong submission flow and sustained growth in the non-admitted or excess and surplus lines marketplace, which carries a positive outlook currently. An additional consideration, only now beginning to emerge, is the impact of the recent U.S. presidential and congressional elections and continuing but possibly shifting domestic and geopolitical risks. But the key headwind for this sector is the persistency of social inflation, as reflected in high claim severity trends in casualty lines, and it's a key concern for the commercial auto and general liability lines of business within the commercial sector. Our stable outlook reflects AM Best's expectation that U.S. commercial line segment will remain profitable in aggregate and will be resilient in the face of near and long-term challenges. It also reflects our view of the risk-adjusted capital of the majority of segment carriers will remain sound, and that the stable outlooks on the commercial property and workers' compensation lines, as well as the positive outlook for the E&S market, the latter of which often diverges from other commercial line segments, will be sustained over the coming year or more. These stable and positive outlooks continue to outweigh the negative outlooks that we have on the commercial casualty lines, general liability, commercial auto, and directors' officers insurance. That concludes my remarks.
All right, very good. Thank you, Alan. Appreciate that. Let's take a question before we move on. Given the steady year-on-year declines in workers' compensation premium rates, does AM Best have concerns that workers' comp, the outlook, could go negative, thereby changing the outlook for overall commercial lines also to negative?
Thanks, Stefan. It's certainly true that all other things being equal, or as usual, the year-on-year rate declines in workers' compensation would seem to be a credit negative trend. But in fact, they have largely tracked and generally followed similar reductions over the course of a decade now in claim cost trends for workers' compensation insurer. These have benefited from a broad reduction in claim frequency and only measured increases in severity over the period. Both medical and indemnity components of workers' compensation claims have seen more measured inflationary trends, enabling insurers to benefit from lower than originally projected ultimate claims cost. At some point, we expect to see an inflection at which premium rates flatten and then begin again to trend upward. But we do not expect to see a hockey stick-like increase in claim costs which is something that would prompt more serious concerns.
All right, very good. Let's take one more before we move over to reinsurance post-election. Alan, does AM Best expect that tort reforms could significantly stem trends that have led to nuclear verdicts and social inflation currently adversely affecting casualty lines?
Certainly, there are four types of reforms that are often referred to: caps on punitive damages, limitations on joint and several liability, caps on non-economic damages, and reforms to collateral source rules. In general, we would expect that a right-leaning legislature would be more inclined to advance some reforms that would be business-friendly and favorable to corporates. In 2017, I believe there were a number of such initiatives fairly quietly being advanced in Congress. What's for sure is that control of both the legislative and executive branch, although by a very slim margin, will make passage of some legislation more likely than otherwise.
All right, very good. We'll stop there and we'll hand over to Carlos to take us through the commercial reinsurance market segment outlook.
Thank you, Stefan. Yes, in June this year, for the first time since AM Best has been publishing outlooks for the global reinsurance segment, we changed the outlook from stable to positive. The main driver behind this is what we believe is sustainability on underwriting profits. We believe that this hard cycle is slightly different from previous ones. In the past, normally we've had these ups and downs driven by a large catastrophic event, depletion of capital, and a sharp increase in rates, which would attract new entrants in the market. In this case, what we see, the main driver has actually been underperformance. Let's remember the change has been relatively sudden. We had a long period of a soft market, which started being corrected after the hurricanes in 2017, 2018. That was a gradual process. It was only in the January renewals in 2023 that we saw this step change and a dislocated market where we actually confirmed the change in conditions. But the adjustment actually started in 2017. We saw 2021 was the first year when companies were actually showing positive underwriting profits. That was after a period of 5-6 years of poor returns which were below the cost of capital of companies. That was a period as well of very low interest rates when the market, say both on the traditional and the ILS side, was awash with capital. And as we said, ROEs were unable to meet the cost of capital. So what we saw in 2023 was that correction, and not just on the pricing side, but on a number of measures to de-risk balance sheets. And that's why we think that companies are in a much better position to actually maintain those margins going forward. So the role of reinsurers has been restored as capital protection instruments rather than earning stabilizers. And we believe that, so the issues that both Rich and Alan were mentioning, the troubles that the primary sector is facing is actually because of this realignment of roles and interests. Something important compared to previous hard cycles is that we haven't seen any capital depletion. As I said, the main driver here has been underperformance. Say companies are actually, there is lots of investor pressure to try to restore the profitability which should be able to meet the cost of capital. A cost of capital which actually has gone up with interest rates. So we haven't seen new entrants in the market, but actually the increase in capital, the increase in capacity has been driven by retention of earnings and has been driven by capital raises from the more established players, which have shown a very successful track record. So what is happening now? We believe this year, so that realignment of interest, we see it's here to stay. Companies moved away from high-frequency layers. Those tighter terms and conditions, we see it very unlikely to change. There is some pressure, but only in the areas which are the most profitable ones, where we think that there is some room for adjustment. So I said earlier, the sector remains very well capitalized, not just in terms of numbers, but in terms of the capital utilization. So there is a gradual level of consolidation where the most successful, the largest companies in the market actually are gaining more prominence, not just because of the size, but because of the broad offering that they have, which is something that cedants are looking for. We don't see the emergence of new companies yet, say partly because cost of capital has gone up as well, because investors are, what we believe, they are assigning an additional risk premium to a sector that they consider very volatile, despite the de-risking measures. So despite probably some new initiatives that we may see in the new year, we don't think that any of these will be a disruptive new entrant, especially on the property cat side. At the same time, demand for reinsurance continues. So cedants will try to restore the risk transfer roles that we had seen in the past. So that is something that is still going to be a point of tension. And we have a number of emerging risks related to technology, cyber, intellectual property, intangible risks, where actually it's a challenge both for the primary sector and for the reinsurance sector to innovate. And last of all, say the role of interest rates is something very, very important in this case, because that is increasing cost of capital, that is definitely giving more alternatives to investors for, say, competing alternatives when they decide whether to allocate or not more capital into this segment. So finally, what do we think about the next 12 months? Say most of these drivers, we think that they are unlikely to change significantly. So underwriting profits, despite the hurricane activity that we saw this year, I think that that has simply helped to maintain that discipline that we expect to continue. I mentioned rate movements. There is some slight room for decline in the most profitable segments, but nothing major. So primary carriers are still forced to retain higher levels than they used to in the soft market. We keep a close eye on casualty lines. So initially, let's remember, we've had a very soft period on the casualty segment between 2016 and 2018. A number of companies have applied reserve strengthening actions. 2019 onwards, there has been more change, more awareness about social inflation and tightening of underwriting measures. We've started to hear some concerns even about those more recent years, but we believe that both in the primary side and on the reinsurance side, any expansion on casualty is being very cautious. It's something that companies are taking, in a very prudent way. But more than that, when we see the financial results, the strong returns that we have seen on the property side actually more than offset any concerns on the casualty side. We've seen companies for a second year, overall, we have ROEs which are around 20% or even in excess of that, and combined ratios overall, which are in the low 90s or high 80s. And we think that this may decline slightly in 2025, but still, the segment seems to be in a very good place for sustained profits. We mentioned we don't see any disruptive capital emerging. On the contrary, what is happening is the largest, the companies with the best track records are able to expand. When we see new capital, it normally happens in instruments where they have the ability to enter and exit the market relatively quickly, like in ILS, which is definitely an important component, an important partner for several writers at the moment. I said, and this is simply expanding the alternatives for sources of capital to keep strengthening a market which we believe is in a very good position at the moment.
All right, thank you, Carlos. Coming back to your commentary on casualty, maybe you can expand a little bit on how much of a concern is the trend that you're seeing in casualty lines. Is it possible, is it likely that your outlook could change because of pressure on this subsegment of the business?
I think that we need to look at these two periods, one before 2018 and post 2018. For the oldest years, there have been significant reserve strengthening actions that we believe should be sufficient at the moment to cover those concerns. For the more recent years, there was a change, a tightening in underwriting terms, in the pricing as well, in the way, companies have been growing in specific geographies, lines of business. And so in those cases, we believe that area is a bit more under control. But more than that, until now, what we see is the strong profits outside casualty are actually, more than sufficient to cover those concerns.
All right, very good. So for the sake of time, let's move on to the life and annuity outlook. Over to you, Mike.
Thanks, Stefan. Okay, so for the life and annuity segment in the U.S., we're maintaining our stable outlook, and that's based on the following factors: strong capitalization across the industry, top-line growth in most of the core lines of business, and consistent profitability. And these are themes you've probably heard before in some of the briefings that we've done before. So I'll try and keep it kind of quick here. First, when it comes to capitalization across the industry, it looks like capital was preserved through the period of COVID. And, COVID turned out to be, for the life and annuity sector, much more of an earnings event than a capitalization event. And in fact, what happened in the post-COVID environment and during that was we've seen more new capital enter the market. So as is alluded to before in an earlier question, we're seeing a lot of sidecar formations. And with that comes capital to support more business. And in addition to that, we're seeing new entrants into the market that are supporting the life and annuity business, in particular the annuity business. We're also seeing capital flowing into new jurisdictions, one of which is the Cayman Islands. So we're seeing new companies being formed there. So overall, we're seeing more capital coming into the life and annuity sector. And from a broad point of view, I think that's generally a favorable development. We mentioned top-line growth. As we've mentioned before, no secret the annuity sector has been on fire and continues to be. We see this as something that has real legs as the annuity business is getting to be more and more of a preferred alternative to bank CDs. So we're not just talking about retirement products, and we're not just talking about variable annuities that have certain guarantees embedded within them. We're even seeing more shorter and medium-term type of liabilities, 3 to 5 year MIGAs, for example, have become a really hot spot in the market. So as a result of that, top line growth has been continuing throughout 2024, and we expect to see a lot of that going on in 2025. And then consistent profitability. Certainly the higher interest rate environment that we've had in the past few years has been helpful, and we know that we're right now in a rate cutting environment, though we don't know how long that'll go on for. But as Stefan had alluded to before, there are some very favorable macroeconomic trends, and so we see that profitability is something that should remain with the sector. Now for the headwinds, the items that are offsetting these positive factors include, well, they're really kind of the usual suspects. So an increased allocation of higher risk assets, the potential for future interest rate cuts, and an ongoing drag from legacy liabilities. So I'll take these one at a time, as I did on the previous slide. First, when it comes to higher risk assets, this has been a concern that we've talked about for a while. And if you're wondering why we continue to talk about it, it's because we're looking at a really prolonged credit cycle that is extremely long in the tooth. And so it's been difficult to see how some of these higher risk assets are going to play out in a poor environment. So even though we see favorable economic conditions going forward, we're still mindful of the fact that balance sheets have gotten riskier and riskier. The one area that we've talked a lot about in the past, commercial real estate, we've yet to see how that's caused significant problems for the industry, although every company we talk to has a little bit there, but it's not gotten to the point where it's actually really harmed any of our companies. However, we're seeing much more on the private credit side, and so we're starting to pay attention to that. When we say private credit, that's really a broad term that we're using. I think over time we're going to probably want to drill down a bit more to think about that. As I described to someone just yesterday, I said we're not in the first inning of the private credit story, but we're certainly not in the ninth. So as we develop more and more ideas about what's going on balance sheets, we're going to drill into private credit and get a sense of really what this looks like. The theme we keep hearing over and over again is the origination side of it really knows what they're doing. And there are certainly some very expert shops that have entered into the life and annuity space. But I think with the current credit cycle, it's really easy for everyone to look like they know what they're doing. So that's something that we've got to really pay attention to. The potential for future interest rate cuts is certainly something that is mindful as we are now hitting an inflection point, as Stefan had mentioned earlier. We're looking at, I think the market feels that there's going to be a 25 basis point cut coming in December. It's really anyone's guess what happens next. So there is some uncertainty around interest rates, and we're going to be following that much more closely as we go into 2025. And then, of course, there's the drag from legacy liabilities, and it's the usual suspects there when it comes to life companies. The business that has been written, 10, 15, 20 years ago, the usual suspects: long-term care, variable annuities with living benefits, and universal life with secondary guarantees. I think in the past couple of years, there's been a few things that have been maybe favorable for that business, but it doesn't really change the underlying profile there as we go year to year and see that these are still liabilities that companies are holding on their books, and they're effectively trying to outgrow the liabilities that they have. There have been a few deals that have been done, so there is a little bit of interest, but I think that this is something that if you've been in those businesses, you're still spending a lot of time and effort to manage those books of business.
All right, thank you, Mike. Coming back to your commentary on annuity sales, with the interest rate hikes tapering off, how do you see the pace of future annuity sales? Can they keep up the red-hot pace that you referred to and that we've seen in the past few years?
Yeah, thanks for the question, Stefan. I mean, I think the reality is that everybody had been saying the usual suspects for what's been going on in the annuity business are, well, the changing demographics, the baby boomers, and also the interest rate environment. But there's some really interesting structural changes that I think are going on right now that are very favorable to the continued top line growth for the annuity business. Most notably is it seems like the big money center banks just really aren't interested in holding your money anymore. And as a result, we're seeing a lot of products that have, very CD-like profiles that are now being originated by, newer annuity companies. And what's backing that now is the private credit that we've talked about. So true disintermediation, but I think ultimately what we're looking at here is we're looking at assets that are in search of liabilities, which is very different from what the industry has traditionally been like.
All right, very good. Thanks, Mike. Yes, certainly feels like the risk profile of the segment overall is increasing and bears monitoring in 2025 and beyond. All right, so we're going to move on to our second to final outlook. Sally is going to take us through the health outlook.
Thank you, Stefan. AM Best is maintaining its stable outlook on the U.S. health insurance industry. The industry remains well capitalized. This has been driven by favorable earnings, which have been accretive to capital, a 5-year compounded annual growth rate for capital that has outpaced net premium, allowing for continued improvement in risk-adjusted capitalization. I would caveat that with, while we expect the industry to remain well capitalized, we do expect risk-adjusted capitalization to decline in 2025. This is going to be driven by lower earnings combined with growth in certain product lines, which will likely result in premium growth outpacing capital growth. We've seen the commercial segment, which is individual and employer group, has reported solid underwriting results over the past few years, a trend which we think will continue. We've seen premium rate increases that are keeping pace with medical cost trend, and we've actually seen enrollment growth in this sector driven by the individual ACA market. And that's been driven by members shifting from Medicaid due to the redeterminations to an individual policy, as well as the increased subsidies for the ACA product, which has made coverage more affordable for some. We're seeing rate pressure from the provider contracts are moderating. Provider contracts are multi-year with staggered renewals. Many contracts have been renewed and renegotiated the past few years to reflect inflationary pressures, which pushed rates higher. Additionally, the recent decline in inflation has led to moderating rate pressure at provider contract renewal. Investment income remains favorable and continues to supplement underwriting income. Healthcare claims are generally short-tailed, and as such, health insurers generally hold a conservative investment portfolio. Strong performance in investment-grade fixed income and equities has driven favorable returns, and health insurers continue to generate strong cash flows from operations. Partially offsetting these factors is, after several years of normal profitability, the earnings profitability, the earnings in both Medicare Advantage and Medicaid managed care are facing pressure. Medicare Advantage is experiencing elevated utilization trends, a reduction in star ratings, and when plans drop below a 4-star plan, some companies continue to offer enhanced benefits in order to retain the membership until they can regain that 4-star benefit and that bonus. We've seen changes to the risk adjustment payment methodology, as well as the impact of changes to Medicare Part D from the Inflation Reduction Act of 2022. For Medicaid managed care, there's currently a mismatch between the acuity of the membership and the current rates. So Medicaid renewals typically use data from the past 12 to 24 months. Given the Medicaid redeterminations, we've seen during the period of the public health emergency, we saw an unprecedented growth in Medicaid as members could not be disenrolled. As members are being disenrolled, we are now seeing large disenrollment from Medicaid. That has led to in-force rates not matching the experience or the trends of the current enrollment, and that will take some time to self-correct. I would note that AM Best expects both Medicare Advantage and Medicaid managed care to remain profitable, but at lower margins, as these programs are normally high-volume, low-margin business. Additionally, insurers are seeing cost pressures from new specialty drugs, gene therapies, and GLP-1s. The various use cases of GLP-1s have expanded utilization across the United States. These drugs are higher in cost and lack competitive alternatives, which has allowed prices to remain elevated. We're also seeing increased uses of and development of gene therapies and other specialty drugs, which can be very expensive and be required for lifetime treatment. All of these are elevating pharmaceutical trends. I would also note that AM Best remains less optimistic about smaller, less diversified insurers. Historically, these plans have been challenged by industry headwinds, pricing pressures, a lack of underwriting discipline, and a reimbursement lag. These plans may lack the financial wherewithal or support of a financially strong parent to provide capital support for the challenges that they face.
All right, thank you, Sally. I think you alluded to this in your earlier commentary. Question for you. Why did AM Best assign a subsegment outlook for Medicare Advantage and Medicaid?
Sure, thank you, Stefan. Medicare Advantage and Medicaid managed care now account for a larger portion of U.S. health insurers' revenues and for the past few years' earnings. In 2023, more than 50% of health insurers' premium and enrollment were driven by these two product lines. Furthermore, with more than half of the seniors selecting a Medicare Advantage plan over traditional fee-for-service Medicare, and with an aging population, the percentage of individuals in a Medicare Advantage plan is expected to continue to rise. And then additionally, according to data from the Centers for Medicare and Medicaid Services, also known as CMS, 75% of Medicaid enrollees were enrolled in a Medicare managed care plan in 2022, and that percentage has been steadily rising as more states convert from traditional Medicaid to Medicaid managed care. And I would note, based on the factors I had mentioned earlier, the outlook on the subsegment is negative.
All right, very good. So last but not least, let's hand over to Dawn, who's going to take us through the outlook for the DUAEs.
Thank you, Stefan. So AM Best is maintaining their positive outlook on the Delegated Underwriting Authority enterprise sector. AM Best has noted continuous and significant year-over-year growth in the sector. This sustained resilience is really a major factor in maintaining the positive outlook into 2025. As DUAEs consistently show their value and demonstrate their capabilities to remain profitable, there is steady and sufficient capacity flowing into the E&S and fronting space, further fueling momentum in these markets. A known characteristic of the DUAE segment has really been this emphasis on offering niche expertise and innovative solutions. And we are seeing a move really towards more micro specialization expertise when assessing emerging risks. The ever-expanding expertise is really supported by strong investment in talent and technology, which allows for speed to market, more data-driven decision-making, and really making a way for more versatility in the sector. Now, while the market remains poised for growth through 2025, there are some factors that are going to offset this positive view. So we should keep an eye on pockets of capacity challenges, as some DUAs really could have an over-reliance on reinsurance and really find themselves faced with more stringent underwriting conditions. And I really say this with Lloyd's market in mind, as they have noted they're putting more emphasis on the quality of risk selection of DUAEs and how they maintain operational complexities, and really looking out for potential misalignments when we're talking about risk management. And then new entrants really can face challenges in building out their governance and internal controls and securing stable capacity, and also ensuring compliance. So execution risks are an offsetting point to watch out for in the market in 2025. But overall, the sector is strong, and it continues to show why there's considered to be such a vital part of the insurance ecosystem.
All right, thank you, Don. So let's stick with the DUAEs for a moment and give you a question. How does the positive outlook for the DUAE segment align with the broader trends in the insurance industry, particularly in navigating market volatility?
Thank you. Yeah, so the positive outlook does reflect the broader industry trends of increased demand for specialization, as I discussed earlier, but also a greater reliance on surplus lines and the adoption of technology. And that's really to enhance underwriting and operational efficiencies. In terms of navigating market volatility, DUAs can really show their value by developing and maintaining, again, strong governance and internal controls, and really having a good understanding of the economic and regulatory pressures that carriers are under, and be willing to maintain those same high level of standards.
Okay. All right. One more question, Don. What opportunities exist for DUAEs to expand into emerging or non-traditional markets, and how can they navigate the challenges of such expansion effectively?
Yeah. There are going to be many opportunities for DUAEs to expand into these emerging and non-traditional markets. They're going to need to do this by leveraging their strategic partnerships. They're going to have to utilize advanced data analytics, as they are showing that they are committed to that, and offering those tailored products while mitigating challenges through, and I've said this twice already, but strong governance, risk management, and compliance.
All right, thank you. Okay, we've got a couple more minutes left. Let's try to move around the different segments briefly here. Rich, let me come back to you. One of our remaining kind of subsegments that's still has a fair amount of negative pressure on it is personal property. The question is, what is AM Best's view on when or maybe whether personal property will stabilize?
Yeah. Thanks, Stefan. I think the main issue with regards to property is rate adequacy, and that could take on a lot of different meanings, right? One is obviously the rate that's being charged, but also the level of sophistication and segmentation that companies can provide in terms of determining what those rates are. Those are very important. Being able to segment the pricing a little on a more granular basis, like you do on the auto. And like I said before, it's hard to do, right? There's a lot of variables that go into a property risk versus an auto risk. There's been improvement, right? There's been biparallel pricing has been adopted by a number of companies. We think that's going to continue. So there is that sophistication coming, and we certainly recognize that there's a fair amount of pricing improvement that's taken place, exposure management that's taken place. I think the key for us to be able to shift that outlook from negative to stable is really seeing those results materialize in the performance metrics before we would change to a stable.
Okay. All right. Very good. Mike, coming back to you, as we talked about, a lot going on these days in the annuity market. How's AM Best viewing the emergence of these new players that you talked about a little bit ago in the annuity market?
Yeah, thanks for the question, Stefan. I mean, the methodology that we use to evaluate companies doesn't distinguish between where the capital is coming from. So, we rate stock companies and mutuals and private equity firms the same way. What really matters, though, is the patience of the capital, the level of commitment from the sponsor. Understanding that this is really a long-term business. And then in addition to that is, as I had mentioned before, it's the type of activities that come along with it. So if the sponsor is someone who's also in the business of originating riskier assets, that's probably going to find its way into the balance sheet of the annuity writer. And all of those things are consideration in the rating process. So we take all of that into account. And in our evaluation, we want to get to the heart of really what kind of business they are, and look management in the eye and understand that this is really a long-term business. And even though I had mentioned that there are liabilities that are coming in that are of a shorter duration, I still think that at the end of the day, the life and annuity business is very much a longer duration business.
All right, thank you, Mike. Okay, we are going to end there. Thank you all very much for taking time out of your busy schedules to join our briefing today. Wishing you all from AM Best very happy holidays, and certainly hope that your outlooks for 2025 are positive. Thank you.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.